Hey, welcome back to yet another midweek special. Now, there's been an eventful couple of weeks, to say the least, where we've seen broad crypto liquidation. Now, that actually has moved billions of dollars and obviously leading to huge price swings towards the downside. Well, this naturally begs the question, where has all the money gone to, right? If we're seeing a lot of liquidations, where is it all ending up? And I think this is where it could easily be explained in two parts, where traders are chasing volatility. So you can argue that traders are part of the culprit for these liquidations because that's their day job, right? As I said, I'm not advocating that you should do what the traders are doing. I'm actually anti-trading, short-term speculation because we're not experts, and the tendency from that is we'll lose money rather than making any profit. And then the other side is investors are building conviction. But moving beyond that, what are the three signals for you to be simply be made aware of? Well, we have the Wall Street's tokenization push. Now we've seen Citi, BlackRock and JP Morgan now scaling on their tokenized treasuries and settlement services. There's been a recent article on Citi have actually launched their custody services around tokenized treasuries under their custody platform to its institutional and retail customers. This is actually very important because the banks, as with any type of enterprise, they need to think about how to make money and how they can provide real yield towards its shareholders, right? So they will start off with tokenized treasuries because, as I've explained in a couple of videos, governments will always need to issue their bonds, and to make it more accessible in the financial markets, the way to achieve that is through tokenized treasury because they offer a more 24/7 coverage and at a fraction of a cost because it's instantaneously settled on chain, which is different from Swift and TradeFi, where it takes naturally several days. So that is a game changer. It won't stop here because Citi is going to broaden its net to cover other digital assets under the same custody platform. And of course, there'll be other competing household brands like HSBC, Merrill Lynch, Bank of America, and many other hundreds and thousands of other leading financial institutions. They're going to be eyeing themselves on what Citi has just launched. And aside to this is another interesting revelation where Open Eden's tokenized treasury fund has just been awarded a AA plus rating from S&P, which gives DeFi real TradeFi credibility. Now, this is very important because this is going to set the golden standard, in my view, for how other tokenized treasuries should be brought onto the mainstream, onto TradeFi. Well, this will naturally open up other tokenized funds to achieve the similar sort, if not a slightly improved credit rating. So it gives it credibility at the end of the day. Why this matters? Because between both of these, it's going to drive even more institutional adoption and not hype anymore. That will translate into providing real yield to customers and shareholders, real compliance, and real liquidity. So this is where I would see the next cycle for RWAs to come out. So very, very interesting times ahead. The next topic, which is interesting, is around sovereign Bitcoin accumulation. Now, we all know about El Salvador and also other governments where they've added their reserves into Bitcoin. We've got UAE and others who've made similar announcements that they're going to join the bandwagon and start building nation-state Bitcoin reserves, which is very interesting, right? Because this is something that I've actually captured as a catalyst for 2025, and clearly we are seeing that catalyst being realized every single month through these announcements of nation states adopting a proportionate amount of their wealth, sovereign wealth, into Bitcoin in its strategic reserve. And what's really even more interesting is there are other countries have certain advantages over some of the others, particularly renewable energy, where it's in abundance, whether it's through hydro mining or through fossils or waterfalls and so on. Incidentally, I just came back from a trip from Iceland where I did a complete tour around the island explaining why Bitcoin mining is really pivoted for those type of highly abundant renewable energy resource supply. Well, that can in itself help mine new Bitcoins and other digital asset tokens at a much more cheaper rate, if not at a zero cost base. So they have other ways to achieve and build up their digital asset holdings in their strategic reserves, whether it's Bitcoin or indeed other digital assets. So why this matters is because state level validation of Bitcoin is taking place. We're seeing that every single month whenever we see these sort of announcements, whether it's a crown prince of the UAE and other nation states. This is just going to add more momentum and more of a drive for having hard assets replacing bonds in reserves, which is what has happened historically. So this signals macro legitimacy for Bitcoin and indeed other real asset tokens. So this is very interesting. And then lastly, as a final topic, there is what I would call a stablecoin power shift. Now, we've seen a lot of announcements around Circle competing with its rival, which is Tether. And I've just explained banks are now starting to introduce custody platforms on tokenized treasuries, the likes of Citi. Now they're all racing against each other to own on-chain dollars. That is what stablecoins are ultimately about, is not to be seen as a replacement of the traditional fiat currency, whether it's the US dollar, the euro, the pound sterling, or the yen. It's meant to extend the life and utility of the fiat currency, but on chain, right? That's what stablecoins are about. It's just a digital form of fiat currency on the blockchain. They're also trying to chase to own tokenized gold and treasuries, but use that more as a new collateral layer underneath. And stablecoins are now dominating the DeFi volume. I think it's well over $200 billion of stablecoins that's been issued globally, and it's growing, right? The trend is to become a multi-trillion-dollar stablecoin industry in the foreseeable future. So whoever controls stablecoins will ultimately control the liquidity, because stablecoins is, in all honesty, the main gatekeeper of bringing in trade-fied wealth into the blockchain arena. That's what stablecoins are all about. Not to be confused, mind you, as a store of value, which for me is Bitcoin, but use it as your expense account, if you like to put it in those terms, where you want to cover expenditures, whether it's through your groceries or buying a coffee or buying a flight ticket or your next packaged holiday for the family. Well, we would expect use of stablecoins to cover those type of needs rather than relinquishing your Bitcoin holdings, which is more of a hard asset long-term hedge. So regulation will decide the winners, right? And we've got a heap of new important regulations out there. In the US, we've got the Genius Act, we've got the Clarity Act. In Europe, there is MiCA. Again, I've covered a recent video explaining the differences between those two crypto regulatory regimes, which I would encourage you to watch. That's all I have for you for today. If you value clarity on Bitcoin, blockchain technology, and real assets tokenization, stay alert. Subscribe and enable all notifications to stay ahead of the curve. Share this episode with those who need to understand what's coming, friends, family, and colleagues. This channel aims to deliver insight, no noise, and no hype. Subscribe now.